Okay, good evening, everyone. This is Justin Paolini for FCI Markets. Thank you for coming. Thank you for taking time out of your day to come to this webinar. I hope you'll enjoy it. Just quickly, if you can let me know if you can hear my voice, if you can see my screen, let me know everything is working. You should have a chat facility where you can let me know if everything is working, if it's okay. Yes, all good. Excellent. All right. Well, we're starting right on time. So let's get the party started. Today we're going to talk about how to execute your trades consistently. Now, just before we start, I'm going to read the risk warning. So our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leverage products trading, it is possible to lose more than your initial deposit. Trading on margin carries a high level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, a little bit about me. Um, Before being brought on board here at FCI Markets, I spent most of my career on the retail side of the market. And this means that I made probably every mistake in the book twice, and yet I survived. And gradually, I built up a career that allowed me to transition over to the institutional space. And now I'm working with 3C analysis, sending signals to institutional traders, and also working here at FCI Markets as head of trader development. So the one thing I guess that I can give you is my experience being a retail trader and what that has meant to my trading personally, what that has meant in terms of difficulties, particular difficulties that other traders that go through the institutional side don't really face. And the one thing I want you to know about us here at FCI Markets is that we're not just offering you these webinars just for your own benefit. We are offering them because we want you to become consistent traders and join us here, either on the desk, at our premises in Billericay in the UK, or remotely, because we have funding capacities, and soon we will also have copy trading capacities as well. So you can be not just a funded trader, but also a copy trading manager, offering your services to other subscribers. But at the basis of this is a consistent trading model. And that brings us back to the webinar. In the previous webinar, we talked about generating consistent trade ideas. And in this webinar, we are going to take some of those ideas and take them forward and see how to execute trades consistently. This is going to be one of two webinars that we're going to do on trade execution. And we're going to look at the common hindrances that block people from actually executing their strategies with any kind of consistency. So the premise is the same as last time. There's a ton of free information that is spread across the net. There are around 10,000 trading books that have been published with rules and whatnot, and yet we still see stuff like this. We still see in aggregate retail traders fighting trends. This is the euro up to the recent past, just up to the beginning of August, and you can see how ever since we broke 110 more or less, in aggregate retail participants have been short the euro all the way up. And that's why we see frequent disclaimers like this, that 76% or over 70% of retail traders lose money. And we have to ask ourselves, why does this continue to happen despite all the education that's out there? So if you missed the last webinar, if you're wondering, what kind of trading ideas we put forth in the previous webinar, just go and search for it. It's on YouTube. Just search for FCI Markets and you should find it, how to generate consistent trade ideas. What we started to show in there was how by inverting bad habits, by doing the opposite of what most people do, you can start on a journey that takes you, step by step towards becoming a more consistent and more successful trader. So today we're talking about the trade entry. And this is it's a little funny, the great unknown, but this is exactly the hindrance that most traders stumble on. The best laid out plans, the best plans in the world, the best discipline in the world often falls short when the trader has to click the button and actually enter into the market. Because at any moment in time, the trader is there asking himself or herself, should I go long? Should I go short? Should I stay flat? And then, to complicate matters, is the great unknown. So after you click the button, anything can happen. And we're going to talk about the mental aspect of entering trades more in the next webinar. Today we're going to be a bit more technical, but this really is the issue. The fact that anything can happen. What happens after you get in the trade really isn't under your control. You can only control how you react to what happens. So let's go forward. The first thing that I would like to suggest, the first thing that helps, is narrowing the focus. And there isn't one hard rule to narrow the focus. What I'm going to show you in this webinar is just following on with the styles and the suggestions put forth in the previous webinar. So basically, we're trying to follow momentum with two models, and one of these is intraday, one of the other models is geared towards a multi-day stance, and then you can also fade momentum with certain parameters that we'll see later. So we have three models that we're going to be looking at. Two of them are following momentum, one of them is fading it. Now, depending on how you trade, whether pro momentum or against it or in any other way, you need to narrow your focus. You can't be sifting through 30 or 40 instruments every day looking for stuff. That really is one of the first hindrances that many aspiring traders stumble with. They think that they need to search for stuff. They think they need to get active. They think they need to have an extended watch list. In reality, my personal experience shows me the exact opposite. The more you focus, the more you can narrow down the amount of instruments that you're covering on any given week, on any given day, then the more you're able to focus and concentrate on those instruments that are performing the best for your strategy. So in this example, we are going to look only at trades from last week, so it's quite recent, that we had on the radar. So this is from our weekly piece, the weekly analysis that we put out on Sundays. And on the weekly analysis, we were talking about gold, we were talking about Aussie New Zealand against the dollar, sterling Aussie, sterling New Zealand, the euro against Aussie New Zealand, there's New Zealand Swiss, and then we're talking about the dollar pairs. So there is a bit of more exotic stuff in here, and then there's the mainstream dollar pairs and gold. So let's start with gold. And the starting point is this: gold into the execution week, okay, which started at the beginning of August, had been trending up, and retail positioning was net short. Okay, now that shouldn't surprise us. We know that retail traders usually do the opposite of what is good trading. So they're fading the trend, they're fading momentum, and we're trying to get on the opposite side. We're trying to get in line with that momentum. And based on the models that we talked about last time, this was a real-time entry. I was able to capture this in real time, fortunately. I tried to do that for all trades for this webinar, but unfortunately, work gets in the way. But this was taken in real time. So from the previous webinar, we talked about basically getting in lockstep with momentum on various time frames. And we will go through them very shortly. But I want you to see exactly what we were talking about, because this is it. We have a pullback. We have a pullback on the hourly chart, and we have a classic candle pattern that formed. So we have a bullish outside bar here that happened after the pullback, and we also have a little bit of a divergence here, a bullish divergence in momentum for good measure to confirm this. We are within the context of a strong upward move, and we're just pulling back from a new high. So it is, we're trying to get you into the good habit of expecting pullbacks, of not expecting the market to continue onwards and upwards without, without challenging the trend, without coming in for pullbacks. We're trying to train you to expect pullbacks and to play them properly. And so all we said last time was, if you are identifying momentum properly, if you're getting in lockstep with the trend, just wait for the pullback, wait till it signals oversold in this case, and then wait until you have a classic candle pattern that looks appetizing, that is self-evident to get on board. But before we get carried away with the actual entry technique, which should once again be self-evident, which should be really obvious, we need to make sure we're on the right side of the market. And when talking with the head trader at FCI, when talking with Kevin, he wanted me to emphasize the fact that most retail traders flipped to a short stance just as gold was breaking out and accelerating into the uptrend. The positioning wasn't really skewed when we were back here, even though gold had started in its climb. But the positioning really got skewed to the downside. So retail traders really started piling in short onto gold when the trend started to accelerate. And so how can we be on the right side of that move? Well, let's use the tools we put forth in the previous webinar. So number one, you have to have a primary trend identification time frame. And we talked about using a daily chart last time. So we're sticking with the daily chart. And we're using a 50 moving average here. It doesn't really matter what moving average you use to define your trend as long as you're consistent. So 50 is a decent measure. You could use anything from a 20 to perhaps a 100, but it should be evident. I mean, it should be sloping up and prices should be trending above it. Okay, it should be self-evident. And when you that you're doing evident things, you're not looking for stuff. Within 10 seconds, you need to identify a trend. And if there isn't one, then there probably is no trend, and so you can just flip to another chart. Now, the second time frame that we're looking at, okay, so we're going in order. Our daily time frame is our trend, it's our bias. Now we're looking for momentum to confirm that trend. And as you can see, the 4-hour chart has confirmed that trend ever since, ever since back here. So for the past 3, 6, 10 weeks more or less, gold has never violated its momentum time frame. It has been trending up continuously on both time frames. And so the last thing to do is to go on to your execution time frame, which is where we were before. And I wonder if you can actually see within this context where our entry was, the one that I showed in the previous slide. It's right here. That was in real time. So that's where we had the bullish divergence in momentum on the oscillator, and we had the outside bar, and this is what happened afterwards. So it was a lucky pick, but it's not so lucky because we are using a consistent method to remain in lockstep with a trend and with momentum inside the trend. And notice how the moment that your execution time frame showed a violation, strong opposite momentum on this first time frame, on the smallest time frame, is when you have to hold fire, and that is actually the moment that changed everything. That was the first moment that the markets, showed that kind of downwards momentum ever since back here, and that actually changed things. And that's the point in time from which price started to decline. So I guess it goes to prove the point that we're not showing you things that only work nice in theory and in hindsight. These are things that will help you trade well in real time. Now let's see another example. This is an interesting example here because it has everything to do with patience and discipline. And these are two qualities that great traders have in abundance. And they are great, and they are qualities that mediocre traders or constant learners really never bring to the table. So the euro has been in an uptrend for the longest time, and we've posted 5-year highs recently. And this is what it was looking like between the 3rd and the 5th of August, which is when we're looking for our triggers. So retail positioning is still net short, and you can see that after reaching the 5-year highs here at the end of July, the market came down, it was pulling back, and retail positioning was reducing the shorts. And then after the pullback, when the market started to print the higher low and it started to push forward again, retail traders started piling in short. So how can we avoid trading in this section here, and what do we need to do? What do we need to wait for in order to get back in line with the market and avoid getting chopped out? Let's go back to those time frames. Okay, so I skipped the daily time frame here because it's obviously an uptrend. The second time frame that we're checking here is the 4-hour chart, because it's our momentum time frame. And as you can see, even though price was pulling back, it had not frame the the 4-hour momentum rule. So the trend's not broken. Okay, it's just pulling back. It's temporarily exhausted. So 2 time frames are still pointing up, and now we can go on to our 3rd time frame to see what things look like. Now on here, excuse me for making this a little bit confusing. I added the pivot, the daily pivot on here because it serves for the execution examples that we have coming up. But just focus on the moving average we're using before. So price from the highs comes all the way back down, closes below the moving average. Okay, nice strong momentum below the moving average. And obviously, since we're conflicting with our higher time frames, we have to stay still for both these days here. And only when the market closes back above the moving average can we start trading to the long side again. And then what happens is that the market goes strongly back below the moving average, and so we have to hold fire. And until recently, it never got through it. So this is this is how you remain consistent with your rules and you avoid getting chopped up. Now I think we're going to zoom in to see these examples. And we're going to use the intraday model that we talked about last time. So this is the short-term intraday execution model. And we were simply talking about something very similar to our hourly multi-day model, which is 15-minute chart. Price has to be trading above the pivot. Okay, it has to dip on the oscillator to an oversold situation if we're trading in an uptrend. So price dips and it prints something of interest. So here we have an inside bar and we also have a bullish outside bar. Typical price cues, self-evident, right on the dip. That's your entry signal. And it was a nice trade. But judging the trade on its outcome is not what we need to do. We need to judge the trade based on the consistency of our applying the rules, of our waiting for this exact situation to present itself. Okay, I should also highlight some of the other things we talked about in the previous webinar, which is for intraday trades, especially you're looking to trade at or near the London Open or at or near the New York Open, and you try to avoid trading near the New York close or when price has already traveled quite a far distance during the day, because the odds of price extending are just much lower than they were at the beginning of the day. You're trying to trade when liquidity is at its best, and you're avoiding the silent times. So you're avoiding the Asian session, and again, the next day you're trading with the same cues. In this case, you also have a little bit of a positive divergence in momentum for good measure, but you have basically an outside bar right here to get you in the market. And price continues up. In this case, it goes and it challenges the previous day's high. But beyond the result of the trade with your trigger. So after seeing these initial examples, and I do have other examples coming up, let's talk about the issues that pop up and why people can't stick to their rules. Sometimes they don't even have rules, but we'll get to that. The first thing is you need to specialize. You can't be a jack of all trades. Now, I get this all the time. When I have newcomers or traders that are new to the market and are just coming in, they see everything moving around and they want to be on everything. They want to capture every 20 pip move, every 100 pip move. If something's moving and they're not on it, they just get really frustrated and they're like, well, I have to trade this. And that leads to overtrading, of course, and jumping in usually at exactly the wrong time. Because what these guys end up doing is flipping through charts, looking for big moves, and getting in after the big move. So obviously they're getting in at exactly the wrong time. So the key here is that you need to specialize. Whatever you do, become a specialist. Now, it doesn't matter, whether you are following momentum, whether you are selectively fading momentum, with the model that we presented or with your own model, whether you are playing some kind of breakout, whether you're playing volatility breakouts, whatever you have specialized in, at least you are becoming an expert at one thing, and you're not trying to be a jack of all trades, because that gets you killed. In the markets, you are in a competitive environment, and you are trading against people that know their system, backwards, forwards, inside and out. So that's why specialization it really is key. The other thing is that if there is no setup, there's no trade. So, going back to going back to the situation here, the market switched back into a bullish stance. Okay, so the trigger time frame confirming the trend in the momentum time frames. If you didn't have a trigger, on either day in either situation, you just have to sit still. Okay, and this happens. I want you to know this happens to the best of us. Both the head trader at FCI and myself, we converse on a daily basis to put out the analysis or the news on Twitter, on our social channels, and very frequently, he will have a signal I won't, or I will have a signal and he won't. And there's no argument there. It simply is that he doesn't have a signal based on his model and he won't trade. And if I don't have a signal on my model, I can't trade. It's as simple as that. You need to respect the decision-making process that you have put in place. There really is no gray area there. The other thing is not having done proper backtesting or record keeping. Okay, the best traders in the world, the consistent traders I've worked with, they all keep good records. They're either attached to my FX book and they have a trading journal, or they're doing everything manually and they're keeping Excel sheets of their own trades. But you need to keep good records in order to identify strengths, weaknesses, things that you can improve, things that you're doing well in real time. So at the end of each session, if you're an intraday trader, at the end of each week, at the end of each month, when you do your reviews, you have to know exactly where you stand. And then the back testing, we could, the back testing is great. Back testing is necessary to test an idea, but things look great in hindsight. It is this whole execution, all the issues about execution pop up in real time. Nothing ever pops up when you're back testing because you're not there. You don't have any money on the line. You don't have, even if it's demo money, you're still committing to a view. You're still committing to an action, and you're risking being wrong. You're risking, being wrong with your timing. You're risking the trade not working out this time, and that really hurts a lot of people that that have that performance anxiety and that really take losses personally, or that can't get over the got to be right mentality. And we'll talk about that. So you need to do proper backtesting. What does that mean? Proper backtesting means going not necessarily candle by candle, although that is the better solution. There are some software packages out there that actually allow you to replay certain market events, but the issue is not tricking yourself. It's being honest with yourself. Do you really understand what you're trying to do? Are you really executing in a way consistent with your rules? Are you really taking note of the subtleties of the setups? things that you would do in real time, because a lot of people try and do the back test, but they're not precise about it. They don't really go into detail. They don't take the time to really, you know, bolt it down, fasten the hatches, and make sure that it's watertight. So they have no anxiety. They have, there's no gray area. I either have an entry or I don't, kind of thing. If you leave gray areas, you know, when you're an experienced trader, you can deal with the gray areas if you want to keep a margin of flexibility, or they could become variations on the theme. They could become, different variations on the same kind of entry setup that you need to take into consideration in order to deal with, market variations. But at least you back tested it. At least you know exactly what you're going to do depending on what pops up. Number 4, getting anxious and jumping the gun. And I hear this very often, where traders know what to wait for, and the market starts to set up, but it hasn't finished producing the setup. It starts to set up. Let's say that you're trading a level, and the market comes down to that level, but it hasn't really done what you want it to do yet, but it's at the level. And so, traders get anxious, and they say, okay, well, it's there. Something's going to happen. I'm about to get my shot. And then they start thinking about the money they'll be able to pile into the bank account and that kind of thing. And it totally deviates them from following the process and from sticking to their rules and from avoiding the emotional impact. So what happens is they typically jump the gun. Even if they don't have the precise setup, since they're there, they're pip watching, they're watching every minute, every wiggle, they get really anxious and they end up just getting into the market at a certain point. More often than not, that's what happens. And it really blocks any performance because you're simply not waiting for your setup. So again, there should be no performance anxiety. You either have a setup or you don't. You wait for the market to set up, and if it doesn't, you let it go. There will always be another trade. There is no need to sit there and worry about missed opportunities. That is part and parcel with this game. End of story. And one of the big ones is the anxiety due to the lack of control over the result. And that's this is a big one, because a lot of people will tell me, I love trading, I want to trade, this is all I want to do in my life. But when they realize that they cannot control the result, when they realize that each trade has an uncertain outcome, things start to go south, and they start to add indicators to the charts. Typically, they start to look for confirmation, for certainty, and everything just goes downhill. And it's all because they are basically immature from an emotional standpoint, because life is uncertain. We don't know what's going to happen tomorrow. We don't know what's going to happen in the next 5 minutes. Anything can happen. There are probabilities, and certain things don't happen that often, fortunately, but anything can happen. And that's why you need to really take this whole trading thing much less seriously, and understand that it's not trading with the markets that's generating the anxiety. It is your expectations and the locus of control, the kind of control that you want to impart over this, which is generating the emotions. And you have to accept the fact that you're making decisions in an uncertain environment. And each trade is essentially a random extraction from a hat. You have no control over what's going to happen in the next trade. But if your system is sound and you did the proper back testing, and you know that you have an entry, and you know that your entries are efficient, okay, and you've done enough, and you've got some experience demo trading or trading on small accounts, all of this anxiety can be put to rest, as long as you're risking the correct amount of money on each trade. Because that's the next point. A lot of the anxiety will dissipate if you are controlling your risk properly. Okay, anytime that you trade too large, your psychological capital is depleted because there is an inverse ratio. There's an inverse ratio between position size and psychological capital and tolerance, right? The larger you trade, the less flexibility there is, the less wiggle room there is, and the easier it is to just deplete your account and destroy it. And that's why professional traders trade very small. Trading 0.2, 0.25 to 0.5 is usually the maximum position size you're going to see, and that's even large. So, you have to trade with a position that is consistent with something you can actually afford. So before each trade, one of the easy things to do here is before each trade, make sure that you're sticking to your position sizing model, and realize, be aware, be mindful of whether you're risking an amount that you can actually, spend on it. Take out if it's, it doesn't matter if it's 10 pounds or if it's 50 pounds, whatever is proportional to your account size. You can actually take it out, put it on the table, put a 10-pound bill on the table or 50 on the table, and just put a note on it. Say, this is what I'm risking. This is what I'm willing to risk in order to obtain a more favorable reward. But you have to be at ease with the amount that you're risking. And if you're not at ease, just cut it in half. If 10 is too much, do 5. If 50 is too much, do 25. It was Bruce Kovner that said that if most traders would trade, half as large, they'd probably become more profitable because they have more tolerance and they have more objectivity when facing the markets. So the other issue about trade entries is time of day, because if you're trading intraday especially, there are certain times of the day that are just ridiculous for trading. I mean, if you're trying to trade the Asian session in foreign exchange and you've got an intraday model based on momentum, you really are in the wrong ballpark. You're trading when volatility is at its weakest, and instead you should be trading when volatility is at its highest. So when there's the transition between Asia and London usually, and then into the London morning, and then when London passes the baton onto New York, those are the moments when liquidity is at its highest, and the market is firing on all cylinders. So know what time of day is appropriate for your model. If you have a longer term model, this becomes less relevant, but still know what timing is appropriate. If you're trading swing, if you're trading for rollovers, if you're trading even your daily, even a daily model, which days of the week are the best. Take into consideration volatility. How far have we gone on the day if you're trading intraday, or on the week if you're trading swing? Are you trying to get in when price is already past 100% of its ATR? Are you trying to trade when the market has already gone up tremendously, like people trying to buy gold in the past couple of days, or people trying to buy gold when it's at multi-year highs or all-time highs? That's when there's more risk. That's when it's less appropriate to try and follow the trend. You should have been already in, and you're a bit late if you're trying to do it now. Then there are other things. There are beliefs. Okay, so now we've gone through the sort of the technical aspects, some basic technical aspects that block consistent execution. Now we're going on to some beliefs. And one belief is that I need to copy exactly what others are doing. Okay, now this is typically what beginning traders and aspiring traders want. They basically piggyback on the confidence of an experienced trader because they know that they're copying exactly what that guy is doing. And I can tell you from experience that even if you have a rules-based discretionary model that is 80% systematic, that 20% of variance means all the difference. There will be people that will not be able to copy your model exactly. There will be people that will take 2 trades correct, and then they will go off on a tangent. So copying is not the answer. There's a reason for this. Okay, as a coach, I need to empower people, not take power away from them. And if you need to copy me, then I'm taking power away from you. You're giving it to me because you're not in control of your results. You're giving that control to me. And that is the opposite of what traders need to do. You need to take accountability for your results, and you need to take responsibility for your results. So if there is something in the model that you have studied or that you have copied from another trader that doesn't resonate with you, you need to change it. You need to go on a journey of exploration, of scientific exploration, and you need to test, and you need to find out what suits you. You need to use common sense, and you can ask us questions, ask us for input. That's what we're here for. But ultimately, you need to find your own comfort zone. That's when you can start building up confidence, when you're doing stuff that makes sense to you personally and that you have proven during your testing and during your back testing and during your live trading that it has an edge and that you can actually manage that. The other thing is, the other belief is that there's only one correct way to trade. Okay, so people that suck up to gurus, or people that can only see things in one manner, or they're not flexible enough to see that there is a world of opportunity out there, and there are different agendas playing out there. There's basically every trader will have variations on a theme. So there are all sorts of ways to trade. The sky is the limit. Okay, there are certain things that work better than others, and that's why we're doing these webinars, to give you, to get you on the right track. Because, like we saw before, most retail traders fight trends, and they fight momentum. So, okay, automatically, if you want to do better than them, you need to try and follow momentum and follow trends. Does that mean that it's not correct or it's impossible to make? Our own head of trading, Kevin Conlon, has made money shorting gold on the way up. But that's because he has a very, he has a watertight model that he's been operating for years successfully that allows him to do it. Okay, but most people out there without that experience and without the discipline to operate a strategy like that will just kill themselves, and that's what happens. Most people just sit on losing positions, or they martingale their account away, or they fight trends for all the reasons that we're talking about here. Now, if you can flip that on its head and start to follow trends and start to follow momentum, at least you're getting on the right side of the market. At least you're trying to do things right, and with a bit of discipline and patience and following these suggestions, you can come out with a profitable trading model. So, there are different ways to trade. Now, we're trying to point you in the right direction. You will eventually have to make it yours. You'll have to specialize and actually make it your own. But, by all means, use the cues that we're giving you, because most traders out there just blow their accounts and they're on the wrong side of the market. So this takes us to suitability, and and trying to force a square peg into a round hole. Some traders just aren't built for trend following. Some traders aren't built for multi-day trading. Some traders really need to scalp. Some traders really need to trade intraday, and vice versa. Some traders need to use a more relaxed approach, and they need, they can't be bothered to, or rather, they find it too stressful to watch the markets for hours a day. Okay, so you can't fit a square peg into a round hole. If you're trying to force a strategy upon yourself just because somebody is using it profitably, okay, you need to ask yourself the question, what objectives do I have? Okay, remember, it goes back to you. It goes back to getting power to you and not delegating it to others. What do I need? If I have a day job, what kind of model do I need to operate? If instead, I have a lot of time to follow the markets, how can I maximize that opportunity? Okay, so you need to ask yourself these questions and then test and see if you are, if that's your style, if it's enjoyable. Because remember that we need to do things that are enjoyable. Trading is harsh enough. Trading really never makes you feel good. Okay, because there's always, you're always leaving money on the table. You're never getting out precisely at the top or the bottom, and your hit rate is always going to be long-term around 50%. Okay, it's very tough to be 55, 60% long-term. So You're not going to feel good because you're winning, because oftentimes you lose and you can get consecutive losses. You're not going to feel good because you're picking tops and bottoms. That's the wrong way to go with the markets anyway. The only thing that makes you feel good is the fact that you are consistent and profitable in the long term. But it's never going to make you feel good while you're doing it. So you need to make yourself as happy as possible during your days, and that goes beyond trading. But in terms of trading, you need to have a style that you enjoy. If you enjoy using indicators, then use them independently from what other people say. If you enjoy naked trading, okay, so only using your price charts, then you got to go down that route. Now today we're talking about executions. So if you like the intraday style of executing your trades and managing them a bit using a tighter leash, then you have to go down that route. Instead, if you like to give things a wider berth, then you go multi-day or you go swing, and you have to do something that you enjoy. And only by testing and trying things out can you actually find out what it is. Sometimes your job or other constraints force you to adopt a certain style, but you'll learn ultimately. If you are journaling, if you are keeping good records that we talked about before, you'll learn about yourself, and you'll learn about the markets, and you'll learn what you will be able to do. And I should add, if you don't have the time, then there's always there will be the option come September. We should have a copy trading option available where you can delegate your trading to us and you can enjoy your day. But if you're learning how to trade, if you want to trade, if you want to make that part of your career, or you want to transition into a full-time trading career, then you need to go down this exploratory path and find your style. The last part is something that I've come across as well, which is I love the markets, but I don't like to trade. There are so many people out there that are better than me at studying charts, reading charts and applying all sorts of different technical models and applying all sorts of indicators, and they can count Elliott waves and they know market cycles. But the fact is that they don't make any money, because when it comes to clicking the button and entering their trade, so going back to execution, right, entering the trade, they can't do it. And they stumble, or they'll get into a trade and they'll exit immediately, or they will get into a trade and they'll fiddle, and they'll fiddle with their stop loss, they'll fiddle with their targets, etc. And they never get consistent, and they never develop the discipline. And when you go and you help them analyze their decision-making process, and you analyze their thought process, the fact is just that they love doing their charting, they love staying in touch with the markets, with the world's developments, but they don't like to trade. They don't like clicking the button, and that's fair. This is just a job. There are people out there that are geared towards trading, and there are people that aren't. There are people, just like there are people that are geared towards being cardiologists or being, surgeons. I certainly couldn't, because I think blood is meant to stay inside the body. I don't like it when it comes out of the body. So there are people that have certain talents and certain predispositions, and if you really find that you're having trouble trading and you don't like it, it just doesn't make you feel good, and there's nothing about it that you like. You have to accept that, and you can't force it. By all means, come and talk to us and try and we can, we can find out, we can help you. But eventually, you can't keep on chasing a chimera, potentially destroying your life, when your talents could be better used elsewhere. So this takes us to what you should be doing when you review your trades, when you review your entries in particular, okay, in order to gain confidence, in order to backtest properly, and ultimately be very professional at what you do. Okay, so here are the questions. And I would encourage you to take these, and as of tomorrow, just try them out on yourself. Was I objective or not? This goes back to your mental chatter. before you take a trade, are you talking to yourself in your mind, or are you simply focusing on the market? Because if you know what to wait for, okay, if your model is very clear in your mind, and it should be written out somewhere too, by the way, and you know what the market, what kind of entry you have, you know what the requirements are, you shouldn't really be talking to yourself. You should be staying in touch with the market with your squawk on, your headset on, or your speakers on, your screen's prepared, you're following the assets that you follow, and paying attention to whenever you're alerted to a potential setup. Okay, you're in the moment, you're mindful. And if you're not in the moment, you're not being objective. If you're talking to yourself in your mind, you're not being objective. So this is about mindfulness, okay, not letting your emotions or your self-talk get to you. Number two, did you follow the rules? Or like the guys I talked about before, did you get anxious and jump the gun? Or did you invent a setup on the moment to justify the fact that you just wanted to get in the market? Okay. And you should be following the rules. And if the rules aren't clear, or if the market is doing things that don't suit your rules, investigate it or come and ask us. But don't get in the market just because it's moving. Third thing is, did you jump the gun? Or did you, or the opposite is, were you too conservative and did you wait too long for confirmation? Once again, these are performance anxiety issues or uncertainty issues. They usually go back to the fact that you're not 100% sure about what you're doing, or you are attached to previous losses, and or you're attached to what happened in a previous trading career. So let's say that you're trying to follow the inputs that we're giving you, but since you come from, I don't know, 7 or 8 years of losses, your mind is still telling you, this is going to be a crappy trade. This is going to be an ineffective trade. And you have to get beyond that. You have to be objective and know that each trade is independent. Let me just have a sip of water. Otherwise, my voice will disappear. Okay, I'm back. So, talking about this, usually goes back to not having 100% clear rules, or not having tested them enough, or focusing on losses, on past losses, or recency bias. There are all sorts of stuff that can pop up, but it's, you have to get over it. You have to man up and go through it and learn from that experience and accept those feelings. Know that they won't go away until you become a confident trader. And confidence in trading comes from competence. Okay, your gut will always fight you until you have taught it that you actually know what you're doing. Okay, your gut will always tell you that you're not a successful trader, this was going to be a loss, until you actually show a good equity curve and you actually say, hey, look, I know what I'm doing. I'm consistent, and I know that ups and downs are normal, but at the end of the month, for the past 5-6 months, I've been up. So there. And you can change your beliefs. You change the way you perceive the market, and you start to retrain your mind, and you align yourself, with reality. It's not easy to do, but it's a process. It's a process. Just like everything in trading, it is a process. We're going to talk about this in I think 2 webinars from now when we talk about trade management. But the other question is, did you manage your trade objectively? Okay, because that's another thing that causes a lot of anxiety. The other thing is, what can I learn? If I did my review, okay, if I'm reviewing my trades and I'm asking myself these questions about previous trades, what can I learn from what I'm observing? Are there any patterns that recur, okay, throughout these trades that I'm looking at? Are there patterns that are working against me, or are there things that I'm doing well? Take note of this, because you can learn a lot from your past habits. Okay, that's why keeping good records is the key. And so many traders I talk to, when I ask them to see their records, they don't have any. So it's just a good habit. All right, back to charts. We love charts, 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 charts. So here we go. Other examples. Now these are intraday examples, obviously. So this here is an example. So we're not talking about the 3 time frame filtering. This is from the intraday setup we talked about last time. Basically just using the weekly opening print and the pivot, the daily pivot, to give you a bit of balance, and then waiting for the overbought or oversold on the oscillator. So obviously this was a short opportunity, short pullback, which was eventually stopped out. So no luck there. This was a long opportunity with a nice outside bar. And this one here didn't get very far. And this one eventually would have been cut break even. And then finally, you have a little opportunity that actually went for a nice run, a multiple R trade here. And this is what happens, by the way, in trading. So you'll have, loss, loss, and then a nice win. You have to have the confidence to hold that win so that it makes up for more than these 2 losses. Okay, remember, if you have a 3-to-1 risk reward ratio, you only have to be right 30% of the time. So it takes a lot of pressure off of that need to be right. Okay, that's why you need to let your winners run and not be in a rush to scale out or to cut them. This is the positioning of the euro yen, on those same days. So obviously the market in aggregate, retail traders in aggregate, are net short, as always. They're short, fighting the trend, and we are just waiting for a long opportunity. So this goes back to the 3 time frame filtering on the hourly chart. So the hourly chart was the smallest time frame, the execution time frame, and obviously, the 4-hour and the daily are trending up. You can go and see this on your own charts. Here we go, almost a near real-time example. Bullish outside bar here, coming from an oversold oscillator. There's also a bit of a bullish divergence here for good measure. This is what happened afterwards. So you get a nice run up to a round number, and price pulls back and offers yet another example, another entry for you there. Oversold oscillator and an outside bar. And these were, just following the trend. So everybody's fighting the trend, but you're on the right side. You're just patiently waiting for your pullbacks, and you're getting in on these simple and self-evident price cues. And you're trying to, and your profits are, you can see it this way, your profits are basically the stop losses, or the losses that other traders have in their accounts that are trying to fade this. And now the last examples are from the other trade setup that we were showing. Now this is the slightly more challenging setup. This is for people that just can't avoid that contrarian mindset, and they have to fade it. They have to be faders, constant faders. So what we said last time is, if you are going to fade, at least wait for some decent overbought or oversold indications on your primary time frames, on the daily time frame, and then wait for a divergence in momentum that can give you a bit of confidence to actually take that trade. Okay, and you always have a stop loss in the market above the highs in this case. So the examples we're going to see are all on sterling pairs. For some reason, sterling pairs were all setting up for these fades last week. So this is sterling Aussie. And so you can see here we had closed outside the top Bollinger. These are this is a 4-hour chart, but these are daily Bollingers, and you can see we had clear closes, daily closes outside of it. So after the daily close, we are looking for a 4-hour divergence. Now we get it. Once you get the 4-hour divergence in momentum, so fresh highs here on the prices and not fresh highs on the oscillator, you're waiting for the first strongly negative bar as a signal, and then you're shorting below it. So this was the first strongly negative bar, and so you're shorting below there. And that was a nice little trade that it gave you. Sterling CAD is basically a mirror image. You get the divergence, prices closing outside the top Bollinger, divergence, strong negative bar, you're shorting below it, and you had a little bit of a run here. Notice how the trade management practices have to be very different here rather than for people that are following the trend, following momentum. You need to keep things rather tight when you're fading the trend, because the trend is your friend until it ends, of course, but fading is always, it's always riskier, because if something is moving, usually it follows the path of least resistance. And then a sterling yen example here. So you have here you have the divergence, the close outside the top Bollinger on the daily level. Then you have the first strongly negative bar after the divergence was formed. So you're shorting below there, and this gave you, one or two shots at getting a little bit of profit out of this. So again, whatever you do, you must have a process. Okay. This goes for trade idea generation. So however you're stocking and filtering your trade ideas, okay, whether it's pro trend, pro momentum, or whether you're going against it, you need to have a process that you have tested, that is logical, that is based on market participation. Okay, so you have to have that. Then number two, you need to have a process for executing your trades that you have tested, that has rules, that's very clear, because if it's not there, then there's no trade. And the same thing goes for trade management and position sizing, which we will see in future webinars. Everything has to be process oriented. Okay, you can't focus you can't feel good about yourself when you have a profitable trade and feel lousy about yourself when you have a losing trade, because that's not the right way to go about trading, or to analyze your trading method, your model. Okay, the ups and downs in your equity curve, okay, the sequence of profits and losses and losses and profits, okay, that's normal. That is not the exception. It is not normal to have 10, 13, 20 profitable trades in a row with only a couple of losses. That's not realistic. Okay, traders that are doing that are operating a negative skew strategy, and you see this very often on on social trading platforms, because they just keep scalping, basically, because they want to be right, so they keep scalping. They have 90% win rates, but their losses are huge compared to their wins. And and they usually just martingale their ways out of that, so it'll work until it blows up. That's not the way you trade. That is not a consistent way to trade and survive in the markets. Year after year after year for 20 or 30 years. And it's not just me that is saying this. Okay, I only have 15 years experience in the markets. The traders that I'm working with here at FCI have 30 years experience or more, and the head trader, Kevin, has traded at some of the largest hedge funds in the world. So we are all saying the same thing. You need to have a process, and you need to trade properly. Okay, there is no cheating the system. Sooner or later, it's going to get you. And this process can be enhanced, it can be studied, it can be made better over time, but only if you keep good records and only if you follow it. Okay. So what can you do? Okay, if you're starting out, okay, if you're new to trading, or you're starting out, or you've been a constant loser, that's okay. We've all been there at a certain point in our careers. Okay, I was there for a few years, like I said in the last webinar. So take our suggestions, take our cues, try them out for yourself. Okay, create your own process built around those rules, those suggestions. Study your process, take notes, keep a journal, and gradually build on that. Okay, there are all sorts of ideas out there on the web. If you look for stuff, you can get in touch with us. I mean, the easiest thing is just to write us, because that's what we're here for. We're here to help you. But write us, get in touch, give us a call. However we can help you, just let us know. But make that process yours, and nobody can ever take it away from you. Your results, your performance. And then you can come on board and things get extra sweet. You can either go for a funded account, or go become a copy trading manager and have a large subscriber base. I mean, you can do both. The sky is the limit. but you need to take this seriously, and and just follow through. So let me give you a little preview of the next webinar that's coming up in 2 weeks. We're going to continue talking about execution, and we're going to talk about market environment filters. So, how to select the kind of market environment that suits your entries. Quality filters. So, what can help you filter out worse setups, and what can help you filter out better setups. We're going to talk about stop losses and targets that that complement your trade entry. We'll talk about entry efficiency. Are you entering the market? When you enter the markets, are you actually doing a good job, or are you entering at random, basically? We're going to talk about odds, so probabilities, and we're going to talk about the role of patience. So coming up in 2 weeks, another webinar on trade execution. Don't miss it. I look forward to seeing you there. But in the meantime, if you need guidance, the first thing to do is subscribe to our Thought Leadership blog. Okay, just go onto our blog, and then the bottom right, click on the box, put in your email, and subscribe. We'll be sending you thought leadership pieces, our morning calls, our weekly calls, everything directly into your inbox. The second thing is to follow our Twitter feed at FCI Ltd UK, where myself and our head trader Kevin put out only the most influential pieces of news during the day, and only charts that look good to us, or that we feel confident about. We keep you basically focused on only the matters that matter each and every day. And finally, if you like this webinar, if you like what we're talking about, and if you want to get on the path to consistency, then come on over to our Professional FX Training Academy. And know that in this academy, the main objective is to get you a funded account. We are still putting the finishing touches on the actual academy, but the idea is to give successful candidates a live trading account for them to trade right away. So, it is a great opportunity. If you're interested, get in touch. We're building our waiting list, and obviously it's first come, first served. So look forward to seeing you in there. And finally, just to wrap this up, know that we're happy to hear from you. Any questions or anything at all, just flip us an email or give us a call. This is our email. This is our number. And now I'm just going to open up the floor for questions. And I want to thank you once again on behalf of all of us here at FCI Markets for taking the time out of your day to come to the webinar. So any questions, just let them roll. Copy trading. Yeah, copy trading is a common question. We are working on that. I actually had a meeting today with our copy trading manager. We should have it deployed in September. We're working on it. It'll be, it's a great piece of software, and more to come on this. But in September we should be launching it. Yes. So if you already have a track record, then you can just send it to us, and we will analyze it. I will run the numbers, and we'll see what kind of performance stats you have. Typically, we're looking for Sharpe ratios above 1 to be considered. But and this is for funding, we allocate based on Sharpe ratios, and even the performance, even the profit split. Sorry, the profit split depends on your Sharpe ratio and your performance. So to get the conversation started, just send us your track record, and how do I know I've got? Well, we'll go through some more detailed statistics next time, but essentially, it has to make sense. So, what we're doing usually is we are candle watchers. We're price action watchers. Typically, we're looking for those moments that the market is talking to us and it's saying, I'm stalling, or sentiment is slightly changing. And those changes in sentiment are picked up by your charts, how the market is trading in the here and now. And whether you're looking at that on the micro frames if you're trading intraday, or whether you're looking at it on the hourlies, on the hour and the 4 hour if you're trading for a swing objective, that depends on just on you and your objectives. But we're always sort of waiting for the market to tell us that it's stalling. We're never really looking to jump in. The entries that we're showing you, the suggestions that we're giving you, are all based on on price action basically, and we are wrapping them in a context that enhances the probability. But we are basically watching sentiment. We're seeing how the market is trading in the here and now, and we're waiting for a precise thing to happen. So yeah, if you are getting in just because a certain line is broken, if you are getting in just because an average is broken or something, number one, if you have not tested that properly, that's the first thing to do. The second thing to do is to see if it's actually efficient. So I'm going to anticipate something we'll talk about next time, which is the mean adverse excursion and the mean favorable excursion from your point of entry. So if your entry is efficient, then you should have very little adverse excursion, and you should have a ton of positive excursion on average. So when you get in, the market should tendentially go in your favor without going against you. That's how you know whether your entry is efficient. And of course, if you don't keep good records, you won't. Any other questions? Seems like there aren't. All right. Well, in that case, I will thank you again for coming. It's always an honor to be here with you and to be able to talk to such wide audiences. I look forward to seeing you in our next webinar. And again, if you have any questions, just reach out to us. This is Justin Paolini for FCI Markets. Over and out.